Everybody, America is still hiring, okay? The bull case is still here. That's going to be a win for your portfolio, okay? Yesterday, June 5th, on Friday, okay, the job report, employment report came out. 72,000 jobs added in May versus an estimated 80,000 expected, okay? That's more than twice as much, okay? What that means is unemployment rate is near its 50-year lows at 4.3%, all right? Now, that's why, I mean, it's at the end of the day, the long run, that's going to be a win for your portfolio. Yesterday, June 5th, was a big down day for the stock markets. Everybody's hurting, okay? Emotionally, mentally. Hey, stay strong, stay disciplined, okay? Remember, Charlie Munger said, hey, the market rewards the discipline, not the clever, okay? 93,000 jobs were for prior months were revised going upwards. Okay, that's great for the economy in the long term. 3.4% wage growth. Okay, that means at the end of the day, if you put all this stuff together, okay, folks are getting jobs, folks have jobs, and then on top of that, folks are getting paid more. That's going to be a good thing for the economy in the long run, despite how the market had performed yesterday. So in this video, I'm going to share with you the bull case on why that is. All right. Welcome and thanks for joining me, everybody. My name's Curtis. If you can give me a thumbs up, click on that thumbs up button, like button right there. Give me a subscribe. If you have any questions, comments throughout this video or towards the end of the video, feel free to drop it into the comment section, okay? I will do my absolute best to get back to you all on that. Thank you. Let's get going. All right, now let's go ahead and take a look at what the stock market did yesterday, June 5th, on Friday, okay? If you take a look at the chart on the left of the slide, that's the S&P 500, okay? It closed at $7,383. That means that it was down $200, okay? If you take a look at the how steep the blue line dropped, I mean, it dropped pretty quickly right after the job reports came out at 8:30 in the morning. And I don't know about you all, but I mean, that was the first thing I was anticipating, the reaction. And so that was the first thing on my mind and the first thing that I looked at when I opened up my eyes yesterday morning. I'd say that, okay? I didn't think it'd get this bad, but hey, we've got a long runway, right? And you've got a long runway, so let's be patient. Let's be disciplined, right? Again, Charlie Munger said, hey, the market doesn't reward the clever, okay? It rewards the discipline. So hold that, okay? Now, if you take a look at the chart on the right side of the slide, that's the Dow Jones, closed at 50,866. That's a whopping drop of $695.15 for the day. Certainly not a good taste for many, certainly not a good taste in my mouth for that. I'd say that too. Tough day, nonetheless, okay? Certainly, I'm optimistic still, and I'm bullish. Why? Because, I mean, again, I just mentioned, right, I've got a long runway, you all do too. And then on top of that, the market always wins, right? If you take a look from 10, 20 years ago, 30 years ago, okay, no matter what had happened, no matter the shakeouts, the dips, the recessions, right, it had prevailed through all that adversity, and it made even more money, okay? And so at the end of the day, it's like what I tell some folks, okay? If you take a look at the stock market, at the end of the day, I mean, it's going to go like this in the short term. But if you zoom out, right? I mean, it's going to start from here, and it's going to end up, I'm sorry, I'm looking at my camera right here. It's going to start right here, and it's going to go all the way up here, okay? Straight line if we zoomed out. So, just something I wanted to share with you all. Now, keep in mind, okay, with this type of job report coming out and how it came out being better than expected, okay, it's great for the economy in the long term, but guess what, right? For growth stocks, for AI stocks, they are very sensitive to these type of reports. And I'll go ahead and break down exactly why in the next slide coming up here, but here's the thing to remember though, okay? Even with today's drop, the S&P 500 is still up over 20% from a year ago, right? I mean, it feels so surreal as I'm standing here and the market is down hard that it's still up substantially. But, again, another thing to add to that is, if you think about it, the Dow Jones just hit a brand new all-time high earlier this past week, okay, or this week. It's still Saturday. So essentially, I view this as a big step back that we had to have, right? I was anticipating, okay, when are we going to have a pullback, right? When is there going to be some sort of huge consolidation or possibly correction? And nobody likes to hear that word correction. And it's funny because when we watch financial news on television, they talk about it being healthy all the time, but nobody really likes it. At the end of the day, I believe that, in order for us to break into newer all-time highs, I mean, we've got to go through this pullback, okay? So enjoy the process. It's tough mentally, it's draining mentally, right? It hurts us physically, mentally, and emotionally. But stay strong, stay disciplined, hold on to your stocks, right? And it's gonna get better. It will get better. All right, so I want to show you all my bull case for this whole situation that we're in right now, okay? Now, have you heard of the phrase, good news is also bad news? Well, let me explain what that means and why it does not really hold up over time, okay? If you take a look at the red box on the left of the slide, that is the worry that traders had yesterday, okay? What happens is a strong job report comes out, okay, like yesterday. It makes the Federal Reserve more likely to raise interest rates, which, I mean, they were already on that trajectory, okay, and they were already anticipating that. So, of course, adding to that makes it worse, okay? And now, of course, there's now about 70% chance that there's going to be a rate hike in December. What's important that you must know is that higher rates what it does is it makes stocks, especially tech stocks, okay, less attractive in the short run. And the reason why is because investors, okay, the way that these analysts, for all these big, huge firms that, that gives us our targets, okay, the way that they calculate the value of a company and its future profits is they use the 10-year treasury yield rate, which they consider the risk-free rate, all right? So if you haven't heard of the risk-free rate, if you're not sure of what that is, all it really is it's the amount, say, that if you were to invest in the 10-year treasury bond, okay, the entity that's going to be paying you out on that, of course, is the United States government. And their promise to pay on that, right, is seen as essentially, basically risk-free, okay? And that's why other foreign nations, they pour, like, Japan, and before China, they used to pour all their money into U.S. government bonds, okay? Different story nowadays. But anyways, it's because it's basically seen as being risk-free. Where I'm getting to is that the 10-year treasury yield is getting higher. And when they recalculate these growth techs companies' values, right? I mean, the values end up dropping because the 10-year treasury rate gets higher. Now, on the flip side of things, okay, if that 10-year treasury yield goes down, their calculation raises the value of the growth tech stocks, okay? So put it this way, okay, if the 10-year treasury yield goes up, okay, when they recalculate those targets, the value of the tech stocks drop. Now, if the 10-year treasury yield comes down, okay, then when they recalculate those targets, okay, it raises the value of these growth stocks. And so if it ends up raising the value of these growth stocks, what do you think is going to happen, right? People are going to move into it to buy these stocks. Institutional investors are going to move in to buy these stocks. When that happens, the institutional investors that own these or operate these ETFs, right? They've got to rebalance it and stuff like that. So ultimately, the stocks, these growth stocks, move up higher if that 10-year treasury yield comes down. So that's one thing, okay? That's one tip that you should keep an eye out on is if you're looking at trading days, okay, keep your eyes on the 10-year treasury yield. If it comes down, that might be a good day to buy. If it goes up, right, the market might be coming down a little bit. So that's one of the main basics that you keep your eyes on when you're investing in the market, okay? Hopefully you understood that. If not, I mean, drop a comment, drop a question into the comment, right? And I'll try my best to help you out with that. Now, if you take a look at the green box on the right-hand side of the slide, this is the real story for long-term investors, okay? Like myself, okay? If you're not retired yet, I mean, if you're under 55, in my opinion, you've got a long runway. I think even if at 55, you still got a long runway. You've got a whole lot of youth, in my opinion, okay? So keep in mind that maybe a little bump in the road like yesterday, okay? And of course, my opinion shouldn't panic you, okay? So because you're investing for yourself, look at it this way, okay? You're investing for your own portfolio. It's not like you have to report every quarter to your partners, to your clients, to those, high wealth individuals like the way that these institutional investors have to, right? That's why they got to take profits. That's why when the stocks jump up just a bit, they got to take that profit right then and there, and sell off the stock. But us, we don't have to. We can choose. Okay, it drops down, 40%. We've got to, we've got to stay strong, hold on to that stock, and gain back at least what we lost, right? That's my opinion. So I'm going to hang on to all the stocks no matter what, unless I have some real good strategy behind whatever I'm doing, okay? Now, you're in great shape because, again, you can keep holding your stock, unlike asset managers that need to show for profits, okay? That's why days like yesterday, once the stock market started dropping, the reason why it drops even more is because everybody starts taking profits, okay? They don't want to lose anymore. Institutional investors drop out. Large funds drop out. Everybody flees, okay? So that causes a chain reaction and a huge pullback. That's exactly what we saw yesterday. So going back to the real story behind all of this, okay? When people have jobs, like the way that the job report came out, they're going to spend money, okay? This job report, employment report that dropped yesterday, it shows that they've got jobs now, okay? Of course, when they spend money, these companies are going to earn more profits. When the companies earn more profits, their stock prices are going to go up. People, if you think about the whole AI revolution right now, the AI build out, etc., all the apps that are coming out, people need to spend on these apps. People need to spend on AI so that we've got more growth, right? To show profitability. Because imagine if AI doesn't show a profitability. That's the bubble that everybody on the news is talking about, okay? But if we've got more jobs, more spending on AI, it's going to continue to grow, okay? That's more profitability shown, right? That's going to grow our markets. That's what we want. In my opinion, the employment report, yeah, sure, for one day, the worst day of the year for the markets, okay? But in my opinion, it's a good thing, for two reasons, okay? Those of you all who don't need to take profits or sell out, you can hang on to your stocks for the long term. That's number one. And then, of course, number two, for the long-term spending of our economy, okay, and the growth of our economy. It's that simple, and it works every single time like that, in my opinion, over the long run, okay? So the market is worried about the Fed, but tomorrow, okay, next year, at the end of the day, we're going to be trading on earnings, and earnings come from very strong job markets. And kind of like what we had just seen released on Friday, okay? A strong job market. All right, everybody. And now, so to wrap up this video here, okay, what I want to share with you all is how everything ties into what truly matters, right? And it's, at the end of the day, it's about your money, your wallet in your pocket, your portfolio, and that's what matters when it's all said and done, when we're at the edge of the earth, okay? Our money, okay? So I can certainly relate to you all in that. Let's bring this all home and talk about how this is important to your money, okay? So the way I look at it is, your finances that you work hard for, that you use to support your loved ones, the people that you care about the most in the world, okay? And if you don't have kids or wife or whatever, you yourself, right? Personally take care of yourself. You're the most important to you. If you look at this slide, okay, I've got 4 different boxes here. We'll go ahead and cover each one of these right here. And the one on the top left, job security, okay, 172,000 jobs. and 4.3% unemployment rate. That means, I mean, to me, right, at least for the better, broader view of things, okay, paycheck is safe. Okay, if new jobs are growing and unemployment rate is stable, it's, to me, your job is the greatest source of income and wealth, and at least for majority of us, okay? This tells us that it's in great shape. That's my point. If you're looking for a job, that's also a good sign, and a lot of people are looking for jobs. So that's a good sign if employment is actually going up. Then on the top right, okay, we've got retirement. A lot of folks are, especially, one of my buddies, I remember when I was, he's got probably a decade on me, okay, in age. And so I remember he told me, hey man, when you start hitting about, your mid 30s, that's when you're starting to really focus on retirement. I'm totally in tune with that. And so for those of you who are totally focused on retirement right now, right, S&P 500, okay, as I mentioned, up over 20% over the past year. That's great news for our retirement. The average 401k balance is now around $141,000. And of course, when the market dips like it did yesterday, it actually is a fantastic chance as an entry point to buy at a discount, okay, especially some of these value stocks. They called, I mean, in my opinion, I think that it's a great time to buy that type of pullback, okay? Purely my opinion, not financial advice, but if I had an opportunity, I would do so, okay? Anyways, again, it's a great opportunity to stack up if you've got the ability to. I'd swing for the fences and hold long. That, of course, that's just me. Now, if you take a look at the bottom left, we've got the purple box, okay? It's called savings. If you're looking to just save money, okay, as a safety net, right? Remember going back to the whole treasury yields, okay, it's up, okay? Putting cash also in a money market fund or a CD, I mean, it's paying you, around 4%, right? So treasury yields, money market funds, CDs, right? If you're just trying to save money, it's a huge win for your savings and emergency funds. That's all I'm trying to say, okay? And then the last one on the bottom right, we've got wages, right? Bigger paychecks. Who doesn't love that, right? Bigger paychecks. Paychecks are apparently up 3.4% over the last year, okay? I do have an argument against that, is that, of course, inflation has inflated quite a bit over the past 5 years. There's no doubt about it. It hasn't been fun. But seeing 3.4% over the last year is certainly better than not seeing any gain. I know that a lot of folks are not getting raises, okay? So to see that, it's a good sign at least, okay? So of course, a strong job market, more funding, greater GDP, it gives you more power to ask for more pay. If you're trying to find a job, if you're at a job where you're very valuable, asking for a raise relative to not being able to ask for it in a, again, in a economy where paychecks didn't rise that much. That's all I'm trying to say, okay? Now, finally, bottom line, okay, that green strip that I put right there, it says, okay, strong economy plus raising wages plus higher yields equals for you to stay invested and keep on buying, okay? That is, right now, this report shows that we've got a strong economy, okay? And so for the long term, stay invested, keep buying. Why? Because that's what's going to drive investments to even greater levels. So in my opinion, you must not freak out and panic sell, okay? Remember this, okay? Charlie Munger would say, avoid stupidity, and the market rewards the discipline, not the clever. And that's all I've got for you. All right. So that's my takeaway from this report. The employment report dropped yesterday. Thank you all for watching. Again, my name's Curtis. If you can, give me a like, okay? Press that thumbs up for me. Give me a subscribe. I appreciate you so much. Thanks for that. And if there's any questions, comments, drop it into the comments section. I would do my absolute best to try to respond back to you all. Thank you for watching. It's Saturday, so hey, make it a great weekend, all right? Have a good one.